Okay, welcome back to another one. This time we'll be looking at the fixed asset note, right? This is one of the hardest, or let me say, challenging notes or documentation that you have to fill in your accounting exams, right? I've seen a lot of students struggle with this, right? Fixed asset note goes into the balance sheet, and as it says, the asset note, it's an asset, falls under your long-term assets, right? Just a bit of clarification. Remember that your fixed asset note is full of, not full of, but it comprises of land and buildings, vehicles, and equipment, right? All these things, theoretically speaking, are things that you can't sell like tomorrow. So think of the house that you live in. Are you able to say that tomorrow I can sell this house and then you get the money back, right? If you say that this house is 1 million rand, would you be able to sell it tomorrow? You wouldn't, right? Whoever's buying it, in a reasonable world whereby they're not Elon Musk or anything, they would have to go to the bank and go get financing and approval and all those things. Those things take weeks and takes a lot of time, right? Hence we say it's a non-current asset. It is something that won't be sold quickly, won't be sold in the current financial year, right? Usually companies keep this for a long time, right? The same as a car and the equipment, right? The equipment, um, a drill and all that. You don't buy that to sell that. You buy that to manufacture your goods or to fix your vehicles or whatever the case may be. Another piece of equipment is your laptops, right? If you are working in a office building, you, your company doesn't buy 20 laptops so that they can sell them tomorrow. They buy them so that you, your parents or whoever who works in that building can now use those laptops to make money for the company, right? Those are non-current assets, assets that won't be sold tomorrow, right? If you look at your trading inventory, I can take a pencil. If I'm a stationery shop, I can take a pencil, go to a school and ask a student that is writing exam on that day, do you have a pencil? If they do not, here's one. I'm selling it for 5 rand, right? Yeah, maybe I should actually start that business. So here I won't be going more much into the explanation, but I want us to focus on the question here, right? This is from November 2022, grade 10 question paper, but it's still applicable for all grades. Like I said, most of these things you get the fundamentals in grade 10 and you carry them through to matric, through to your final paper, right? So let's see here what they want us to do. They want us to find the amount for land and buildings. They want us to find the amount for land and buildings here, um, the final cost amount, the equipment carrying value, the depreciation for the year, and the disposals at carrying value, right? Remember that what you're looking for is this balance here, the total, that is here, which is all the carrying values added together to give you that total. That is what you want. That is the amount that is going to go to your balance sheet, right? But then in this question, it's more simple. They're not asking you to do that. They just say calculate those individual amounts. So we know that here, your carrying value here, your cost at the end is just your cost in the beginning plus your additions minus any disposals, right? Since there's no disposals, it's just cost plus additions, right? So there we know that our cost is 3 million rand, 3 plus 760,000. 760,000, right? That will give us 3,760,000. That is your answer, just like that, simple. Remember that land and buildings does not have any depreciation. We never depreciate land and buildings. Hence, there is no depreciation amount here. There won't be one here, meaning that the cost amount of 3,760,000 will also be the carrying amount there, right? Second, there, carrying value for equipment. We know that the formula for carrying value is cost minus accumulated depreciation. So there we know that our cost is 420,000 minus 160,000. 420,000 minus 160,000. Always remember, your carrying value is cost minus accumulated depreciation. In every single case, this will never change, right? Which should give you 260,000. And that is your answer for number 2, right? Now we're getting to the more challenging ones. Depreciation for the year, point number 3. Now let's go to our information. Information 1 says depreciation on equipment is calculated at 10% per annum on the diminishing method. So we're going to use this one. Diminishing method, remember, it is when calculating diminishing method, it's, I'm just gonna write dimi here. Diminishing method here is gonna be cost minus accumulated depreciation in brackets multiplied by the depreciation percentage. So this is the depreciation amount, accumulated depreciation amount, right? And then multiplied by the depreciation percentage, and then you get your amount. If you're calculating depreciation on cost, it'll just be your cost price, cost multiplied by depreciation percentage, then you get your answer. That's it. Remember these two different ones. One that is usually challenging is this diminishing method, right? Just because of the accumulated depreciation part, but we'll do it here and I'll show you, right? So they're saying depreciation on equipment is calculated at 10% per annum on diminishing method. All right, so here we have to do two parts to this, right? We have to do our first, we have to do our old equipment, calculate the depreciation on our old equipment. Then we come back and calculate depreciation on our new equipment, the additions, right? Don't forget that this equipment also gets depreciated because we did not buy it at the end of the year. If we read here, new equipment was purchased on 1 October 2021, right? So let's calculate that. Depreciation on our old equipment, we didn't sell any equipment, so it will just be our cost, 420,000 minus 160,000, 160,000 multiplied by 10%. As you can see here, we've already calculated this, right? We've already calculated the carrying value. I forgot to say this calculation in here is your carrying value. So you could say calculating your depreciation on diminishing method, you're just saying carrying value multiplied by your depreciation percentage, right? So there we know that we had 260,000 multiplied by 10%, and we know that this gives us 26,000, right? But we're not done. Remember the new vehicle that was bought, we also have to account for that depreciation since it was bought on the 1st of October. So 160,000 on the 1st of October, 160,000. Now, what's important here is that you understand when this vehicle was bought. When I say when, I mean the timeline, your timeline, right? When your financial year starts and when your financial year ends, right? The financial year ends on 30 June 2022. So you know that then it started on the 1st of July 2021, right? So we draw our timeline there so that we understand everything. 1 July 21 and 30 June 30 June 22, right? We bought this on the 1st of October 2021, so not there, but somewhere closer to July, so somewhere there, 1 October, right? Now remember, in this one we account for the amount of time from the day we bought it up until the end of the financial year, right? These months in between. So we account for this period over here, which is 9 months, right? We're accounting for 9 months, right? Remember, when you're counting your months, you must include October and you must include July. So when you start counting, say October, November, December, January, February, March, April, May, and June, 9 months, right? So here we're going to say multiplied by 10%. Remember, here it says that we are calculating on diminishing balance, right? On diminishing balance. But since it's a new vehicle, it does not have a balance, right? It was never depreciated before. Remember, when you depreciate something, you're saying that it has wear and tear. Think of your phone. As the more you use your phone, the slower it becomes, right? Because you're adding more photos on your phone and videos and all that stuff. Your phone falls a lot, so the screen cracks and the body has scratches and all that stuff, and you're using your phone while eating, so it has tomato sauce and all that. It's depreciating, right? The same way happens here. The same day you buy your phone, it has no depreciation. It's still new. You're the first person to use it. So the same way, this vehicle this equipment has no depreciation. It's still new. Therefore, we're going to account for the whole depreciation, right? We're going to calculate depreciation on the beginning balance. Next year, when we calculate depreciation, to show you an example, we're then going to say 160,000. Oh, that is ugly. 160,000 multiplied, sorry, not multiplied, right? Before I continue there, let me fix this. It's not 16,000 since it didn't go on for the whole year. It's 9 over 12. This will give us 12,000 instead of 16. 12,000 rand, right? And then here we now say 160,000 minus your accumulated depreciation of 12,000, brackets, multiplied by 10%, and that will be for a full year, so we don't need to add that 9 over 12, right? Let me just erase this now, and then we continue with our answer. Remember, now we have two different depreciations. They just want this one here for number 3. So what we do is add them together. So we're going to say 26,000 plus 12,000 gives us 38,000. And that is our answer for number 3. Right? Moving on to number 4. Number 4 is asking us to calculate the disposals on carrying value for vehicles. So let's read further here. Depreciation on vehicles is calculated at 15% per annum on cost, right? This one is on cost. We don't factor in the depreciation. And then they further tell us that depreciation vehicle was sold for 112,000. Now, if you were doing your income statement, this information would be important. But since we are not doing your income statement, disregard this, because all you do is confuse you. Forget about how much it was sold for. We don't care about that, right? All you want to know is when was it sold, what was the cost price, and accumulated depreciation on 1 July, the beginning of the financial year. Remember this one? 1 July 2021 was the beginning of the financial year, right? So for the opening balance, this car had 216,000 depreciation. Now remember, we don't calculate vehicles on cost. We don't calculate it on a diminishing method. We only calculate it on cost. Therefore, when we calculate the depreciation for the current year, we will not factor in the cost, right? Now, what is the reason for us calculating the depreciation for this current financial year? Remember, let's go back to the cell phone example. When you're using your phone and you bought it whenever you bought it, and your financial year starts in January, ends in December, when you sell that phone in February of that year, you have used that phone all throughout January, and if you sell it on the 1st of Feb, you would have just used it all of January, meaning that you have to account for the depreciation that happened in the period that you've used the phone. Do you get me? If you've dropped that phone, that means that amount will factor into that depreciation. You can't just say that I've used the phone until the beginning of the year and I sell it in February, but I'm not gonna account for the depreciation for February. No. We can't do that, right? So we come back here and say, when was it sold? 1 March 2022, right? Wait, no, my years are wrong here. 30 June 2022, yeah. So this is 22. 21. This is 21 and that's 22, right? Always remember your timeline. It helps you understand. It helps you put things into perspective, right? I'll show you why just now. They said that we sold it on 1 March 2022. 1 March 2022 should be around somewhere here. 1 March, right? Now, the previous one, the one whereby we bought a new vehicle, we wanted to know what is the depreciation from the moment we bought it up until the moment we sold it, right? But here, from the moment we bought it up until the end of the financial year, here we want to know what was the depreciation from the end of the previous year up until the day we sold it, right? So just for perspective here, when you sell asset, you account for the depreciation from the beginning of the year till the day you sold it, right? When you buy an asset, you account for depreciation from the day you buy it up until the end of the financial year. Do you get me? Sell beginning to the day you buy, to the day you sold it. Buy from the day you buy till the day until the end of the financial year, right? Accounting is a subject that makes sense. You don't just cram information like other subjects. It's a subject that makes sense. Try to make this make sense to yourself. If you buy an asset, how do you account for depreciation before the day you bought it? You can't. It was not there. Think of a cell phone. You can't say this phone screen was broken before it was even used. Do you understand? The same way, you can't account for depreciation for something when you no longer have it. If you bought your phone whenever you bought it and you sold it to me, the day you sell it to me, you're done. You don't care about the depreciation. Whether I take that phone, create a YouTube channel, and see how strong and durable that phone is and break it 50 times, it doesn't matter to you because the phone is out of your company. Do you understand? Hence, we only account for the depreciation from the beginning of the financial year up until we sold it. So, how many months was it since the beginning of the financial year till the day that we sold it? 8 months. Right? Let's count it. We include July, but we don't include March. Remember, it's the 1st of March. Right? So it's going to be July, August, September, October, November, December, January, February. And in February, you don't include March. Right? So how do we calculate it? They said on cost. So we're going to say the cost price, what was it? 360,000. Did I? I did not. Okay. 1.4. 360,000. 1, 2, 3. Multiplied by, what is the depreciation? 15%. 15% multiplied by 8 over 12. Always remember to include the 8 over 12 the same way you included the 9 over 12 there. Right? So now you're going to say to yourself, how much is that? That is going to give you 36,000 rand. 36,000 rand. Sorry. 36,000 rand, right? That is the depreciation for this vehicle for the current financial year, right? And then now you're going to calculate what was the amount that it was disposed for, right? Remember here it says, it even tells us disposals happen at carrying value. We said to ourselves, oh, I removed it. We said to ourselves that carrying value is your cost minus all your accumulated depreciation up until the day you sell it, right? So same thing we're going to do here. We know our cost is 360,000. 360,000 minus what was our accumulated depreciation. At the beginning of the year, our accumulated depreciation was 216,000. So here we're going to say 216,000 plus our depreciation from the beginning of the year up until the day we sold it, which is another 36,000. Now we know that our answer then becomes 360,000 minus 252,000, and that gives us 108,000. That is the answer we put in the place of number 4 there, right? That is the answer there. Right, so you are done. This is your full, how much is this? 20 marks. Do what I just did here and you get your full 20 marks. Remember, in this scenario, yes, it's you know that it's carrying value, cost at the beginning of the year here. Cost at the beginning of the year plus additions. You know that, but you have to show your teacher through the equations. Show your work, right? Show your work so that you can get the full marks. Show your work so that you can get the full marks, right? Through it all. I just want to come back to this before I close up and say that if you're dealing with your accounting, your income statement, then in your income statement you'd have to show a line item regarding this transaction here, this transaction of the sale of the vehicle. What they want to know is that did you make a profit or a loss on the sale of the vehicle? Now, how do you figure that out? You're going to say to yourself, selling price, whatever you sold the vehicle for, selling price minus your carrying value. Why? Carrying value is how much your asset was worth the day you sold it. So for example, the same example we did with your phone, right? Say you bought the phone for 10,000, you were eating your McDonald's chips and with tomato sauce, your little sister or little brother dropped your phone a bunch of times, you were playing sports with your friends or they were chasing you and you dropped it and the camera broke and whatever, and the day you sold that phone to me, it's no longer worth it's no longer worth 10,000, it's now worth 5,000, right? But now, since you are smart, you negotiate this with me and say, look, man, this phone is fairly new. I bought it last year. Even though I put this phone through a lot, I bought it last year. The software is still good. The updates are still amazing. It is an iPhone, it's durable. Take it to iStore, they'll fix it right up for you. It's not too problematic, this phone. And plus, a brand new one would cost you around 8,000 Rand. So, give me 6,000 Rand and we call it a day. Me being me, I give you 6,000 Rand, but the phone was worth 5,000 Rand. So, you made a profit of 1,000 Rand. Right? Let's check the other one. If you make a profit of 1,000 Rand, then this is a profit on sale of an asset. That is a line item in the income statement, which goes to other operating income. Different example. Your phone is worth 5,000 Rand, but you come to me and say, look, I want to sell you this phone, but I want to sell you it at 6,000. I say to you, no. I am going to have to fix the camera on the phone. I have to clean the phone, so I have to get special equipment to clean it and so forth and all that, and it's going to cost me a lot of money. So I am willing to give you 3,000 Rand for this phone. I know I'm such a good negotiator, right? This will give you negative 2,000, meaning that you lost 2,000 on a phone that is worth 5,000. You sold it to me for 2,000 Rand. This means you made a loss on the sale of the asset. You with me? Now, knowing what we know now, let us calculate the profit or loss that we could have made on this. Remember this information I said you should forget? Now let's use it. The vehicle was sold for 112,000. So we said selling price 112,000 minus carrying value 108,000. Is it 112 or 122? 112, right? So we get a positive amount of 4,000. This means that the company made a profit on the sale of asset. You put this in your income statement, you put it under other operating income, and you get your marks there, right? So that is our fixed asset note. Remember, this is grade 10. It is not asking a lot from us, but if you understand this, especially this section on depreciation and this section on buying a new vehicle, so this is depreciation for a new vehicle and old, and this is for the vehicle sold. if you understand these two sections, whatever grade you are, promise me, trust me, I mean, you will be good, as long as you also practice with your paper. But yes, that is it, and I hope this has been helpful.